We talk about how perhaps investors are buying the dip. Should investors be doing that, especially for Asian markets? Or, should we be cautious given what's happening in the resurgence of virus cases? And we see that delay yet again in the Singapore-Hong Kong bubble.
Good morning. Yes, the critical question perhaps. And of course, unfortunately, the virus is still with us. And there remains a degree of uncertainty around the virus itself and the policy response. But for us at the BlackRock Investment Institute, we are, I would say, still quite constructive, even with equity markets in the US and elsewhere having done quite well. And there are two main reasons for that. Firstly, what we call the activity restart. The vaccines are coming, I'm sure slower than all of us would like, but they are coming, and that is facilitating an activity restart. This different date in different parts of the world, but a move from going from restrictions on to restrictions off, allowing people to get out and spend money. So that activity restart, combined with still very large ongoing policy support, most importantly from the Fed, we think that combination is still quite constructive for risk. And as a result, we're overweight global equities, and within the regional mix, we're overweight Asia.
Where would you buy in Asia, Ben?
So I think Asia's, of course, particularly interesting, perhaps, in that it slightly speaks to the broader heterogeneity of emerging markets. So I still think North Asia, or with the gearing into the tech cycle, semiconductor shortage continues to be a big challenge for the world. But obviously, if you're the right side of that, as it were, if you are one of the economies that is geared into solving that problem over time, that continues to be a quite positive tailwind. For us, China continues to be a critical part of people's portfolios. And we think that that's only going to become more the case. We still believe global investors are strategically, if you will, underinvested in China, and will need to continue to close that short over the months, quarters, and indeed years ahead.
Ben, is there a sense that perhaps investors are underestimating inflation? We heard from former PBOC Governor Zhu Xiaochuan talking about the risks of inflation.
Yeah, we think so. So we at the BlackRock Investment Institute have actually been writing for a couple of years now about something we call the policy revolution. So the policy revolution isn't so much the pace and the scale of fiscal and monetary response, although obviously they've both been super huge and super fast. But the revolution is the blending, the overt blending of fiscal and monetary policy throughout the West in order to serve broader societal goals. And we all understand why that's happened. The virus has been frankly, an appalling catastrophe. So, of course, we all get it as to why the policy setting went to maximally supportive, of course. But it is a revolution, and revolutions have consequences beyond the specific ones, perhaps, for which they were designed. And one of those consequences, we think, as to your question, is to at least consider the potential that inflation, which has been dormant for most of the last 2 or 3 decades, could be due something of a comeback.
Ben, the Bank of Canada is the first one at the moment to announce that they're going to be withdrawing stimulus. Not much of a tantrum following that. Others may well follow down the line. The point being here, it does, in the case of, let's say, the Fed, does then all the stimulus money perhaps pick up the slack of that accommodative monetary stance that these guys have been taking?
I think so. So we've had the Bank of Canada, Norges Bank in Norway as well, making we should be clear here, very, very small steps towards perhaps the beginnings of moving away from the full gas pedal, I guess. So that is true and important. However, for us, the big deal remains the Fed. And we think that they are sincere in having adopted a new framework where it isn't just a framework that tolerates what historically would have been considered above target inflation. It's a framework that actually is working towards that. And I think as the Fed has been, it seems to us, very clear, they mean it. They are sincere, and now they need to demonstrate their sincerity by doing it. So for us, the Fed is going to continue to err on the side, if you will, of being too supportive, because they think that that's the right mistake to make, given, unfortunately, the still uncertainty around variants, virus, and so forth.
Well, absolutely, and this is it, isn't it? I mean, this is also going, what you just answered was essentially going to what Haslinda was asking about inflation being underestimated. The thing is, are other things at the moment really causing or being dealt with a sense of complacency? And I'm talking here about geopolitics, the rhetoric surrounding China from Australia today and the US as well certainly should be bringing that more into focus. What do you think?
Yeah, we would agree. We think that's correct. So the tensions between the US and China, as you rightly observed, Rish, it isn't just the US and China. There are many players, but I think we can all probably accept the US and China likely to be the two dominant powers for the rest of the century and perhaps beyond. So the US-China relationship, of course, is very important. And our framing would be that the tensions between the US and China are structural in nature. So what that means is, even though we have a very important changing of the guard on the US side, from the previous administration to the current administration, and that will, of course, result in important changes of style, of tone, and so forth. But actually, there will be perhaps a surprising degree of continuity, because these tensions between the US and China are structural. They are bigger than any one person. And given the structural nature, they're going to persist. And I think we've seen, for better or worse, I think we've seen some pretty good evidence of that since the new administration took power and ongoing.
Well, that also brings us nicely to what happens with the dollar next, because where the dollar goes has a correlation with demand for emerging market assets in particular.
That's right. So we think the dollar is due for something of a pause, I guess, and a similar thought for yields. So the big move in 10-year, we think, has mostly happened. Over the strategic horizon, we still think yields can move higher for some of the reasons we've talked about here around inflation. But in the short term, it seems like the big move is done, and that's obviously quite an important constructive backdrop. So dollar rather stable, and that sees us warming up to EM debts. We're still tactically neutral EM debts, but clearly if it is the case that the dollar is going to be stable, US yields rather stable, and we've got this global activity restart, then that is potentially quite an encouraging backdrop for EM risk broadly, I guess, and sees us warming up to emerging market debt in particular.